My name is Michael Duke, and this is the show where I talk about stocks that are interesting. So if you find that interesting, then please consider liking this video and subscribing to the channel so that you see more of my content. Very, very, very interesting show we have today for you. Funny story here. This stock here, Jackson Financial, JXN. So I actually started recording this video much earlier today, right around this time frame here. Okay, and the price was down. It was like $66, $67 a share. It was down like almost 5%. And I recorded 45 minutes of footage, and I really needed to go to the bathroom. So, and I wanted to pull up some additional reports and stuff. And so I paused the recording and I went to the bathroom, and I look at, as I do while going to the bathroom, I'm, looking at the market, and I see that the S&P 500 is up like 8%, 7 or 8%. And I'm like, what is going on? Well, of course, today the Nasdaq had its best day since 2008. In fact, you see here, the SPY up over 10%. The S&P 500 was up, almost 10, 12% on the Nasdaq. I mean, this is crypto type volatility in an index, right? Every single sector up at least 3 points. Even value stocks up 7.5%. Of course, today, Donald Trump on Truth Social announced that he was putting a 90-day pause on the expanded tariffs, and that a 10% blanket tariff was in effect for all nations except for China, which would have an additional 21% tariffs. So obviously that eased significant pressure in the market. But what happened was with this stock, it went from 60, less than $68 a share, and ended the day at over $77. It was $10 a share swing. And I mean, that's like 15%. So I wanted to preface this whole video by saying that this stock here is significantly more volatile than the benchmark. So that's going to color our analysis today. So let's get into it. Let's discuss the stock. Okay. So what is Jackson Financial? This is going to be a much longer video than normal. And the reason for that is that this company is fairly complex to analyze. And I'm going to do my best when it comes to the financials. But it's definitely more complicated than what I normally cover. And the reason for that is because of what the company does and the regulatory requirements. So Jackson Financial provides a suite of annuities to retail investors in the United States. It operates through 3 segments: retail annuities, institutional products, and closed life and annuity blocks. The retail annuities segment offers various retirement income and savings products, including variable, fixed index, fixed, and payout annuities, as well as registered index-linked annuities and lifetime income solution. The institutional products segment provides guaranteed investment contracts, funding agreements comprising agreements issued in conjunction with its participation in the Federal Home Loan Bank Program and medium-term funding agreement-backed notes. The closed life and annuity block segment offers various protection products such as whole life, universal life variable, universal life and term life insurance products, as well as fixed index, and payout annuities. This company is an insurer, and the way that it sells its products is it has several different sales channels. In fact, it says here, it sells its products through a distribution network that includes independent broker-dealers, wirehouses, regional broker-dealers, banks, independent registered investment advisors, third-party platforms, and insurance agents. So if you've ever met with a financial advisor that has the ability to sell life insurance in addition to investment products, think about the annuities portfolio that they can offer to you and the life insurance containing Jackson Financial products. That's what the company does. A little bit of background. It's only been trading with its standalone ticker, JXN, since 2021. It was spun off from Prudential, and that in the time that it has since spun off, it has transformed its business somewhat. And we're going to dive into that. As always, I'm going to take a look at the financials. I'm going to look at the earnings reports and some of the decks. I'm going to discuss if it has a moat. I'm going to take a look at the valuation. The dividend does pay a dividend. I'm going to take a look at the chart to discuss some of the risks, and then I'm going to grade it as I always do. So let's discuss the deck here. So this is the investor presentation that was presented in late February of this year. A couple things I want to highlight here is the difference between GAAP and non-GAAP earnings is significant. It's in fact it's demonstrably more significant than most companies. But one thing to notice: 1.4 billion of non-GAAP earnings. We're going to look at non-GAAP, and there will be an explanation of that later. But 1.4 billion of non-GAAP versus a $5 billion market cap. The forward price earnings ratio is less than 4 times, 3.38 times. And that's roughly equivalent. It's almost the same as the trailing 1.4 times 3 is 4.2 billion, right? So that gives you an idea of just how low the earnings multiple is on this company. Very interesting, right? Produced $767 million of free cash flow. Again, that's like a 15% free cash flow yield. Significant free cash flow yield at the current valuation, of which 631 million in 2024 was returned through dividends and repurchases. So enormous shareholder returns on paper in the last year. Retail annuity sales up 39%. The statutory capital position of 572%, meaning they have, a liquidity position of 572% of the requirement. Most companies in the sector, to my knowledge, kind of guide or plan to have around 400%. Jackson plans on 425%. We see that here. So their target was for 2024 to return 550 to 650 million to shareholders. They did so. They want 2 years of liquidity, which is probably a lot more than you have in your emergency fund. 2 years of liquidity, that would represent 250 million. They have almost 3 times that. And here they're 425% risk-based capital. Just a few metrics on what the company's done since inception as a standalone ticker. They started off with $50 a share dividend. I meant 50 cents. 70 cents a share. They recently increased to 80 cents a share. Okay. So again, at today's price, that's $3.20 a share. representing roughly 4%, more than 4%. Basically a high yield stock. And you see that they've grown that significantly. And they started off with 91 million shares. They've bought down 18% of share count in a cumulative between dividends and share purchases, $1.8 billion. So, what has that translated to? It's up 145% since the spinoff. And the current price is down from an all-time high at close to $110 a share. So it's in a pretty big drawdown, especially at the beginning of today when it was $67 a share. So that gives you an idea of the high beta, high volatility of this name. Very interesting, right? We have a very high dividend yield. It's not a 7-8% yield like some of the things that are out there today. It's not an ultra high yield, but I would consider anything above 4 to be fairly high. This foots the bill, but the most recent dividend increase was 14%, 10 cents a share per quarter. So we have a 4% dividend yield growing, at least backward looking, in the low to mid teens percent. That's just phenomenal dividend growth, right? So we're looking at a very interesting and compelling potential opportunity here. This here shows the product mix at inception versus today. I'm not going to decipher what these means. These are just different types of annuities here, and then the institutional block at 1.96% variable annuity, I believe that's what it is, and they've since diversified into different products. The significance of that is just that the diversification of the annuity types just means a diversification of the types of benefit, or really in terms of the financial impact of that, the type of liability that they're taking on. Again, insurers, annuity sales companies like this, phenomenally lucrative business model. I take your money today, I invest it in assets and pay out the benefits on top of that, and collect fees and investment income at a spread above my stated benefit to you, right? So very, very cash generative business model, right? Does it have a moat? While we're on the topic of a cash generative business, well, I wouldn't say so. And again, I'm not a annuity salesman. Okay. I'm not an annuity salesman, nor am I an annuity expert. However, just applying a common sense framework here, and my mind is very open to be changed by this. If there are annuity experts out there lurking, watching, comment below, explain to the viewers how Jackson stacks up versus other annuity product sales enterprises. But when we're talking about these financial products, they're somewhat commoditized. Whereas if the investment advisor or the financial advisor is showing you the binder full of annuity products, educating you on the different product types, there's really just a differentiation of the amount of fees there, the differentiation there on the returns, the metrics there. So these insurers compete on rates, and annuities compete on fees and yields to the holder. Commoditized businesses should have volatile earnings, particularly insurers, and should trade at low multiples. So the super low multiple that we're looking at there, it's maybe not as low as it seems when you have other insurers in the market that are trading at 6 or 7 times, but still low comparatively. Okay. You're probably never going to see a business in this sector that's trading at 20, 30, 35 times earnings. Like some of the ones we covered. In fact, just yesterday, I did a video about Republic Services. It's like 35 times earnings. And I like that stock, right? This is a completely different type of company. But anyways, let's talk about the 2025 financial targets. They aim to return $700 to $800 million, representing 11 to 27% increase from the prior year. And part of that was they increased the dividend by 14%. And then these other two targets remain the same. So they are very, very focused on generating shareholder value by taking the enormous pool of liquidity that they have and returning it to shareholders. Now, it's not just purely enriching the shareholders at the behest of the company, because again, in the last year, they did not return the entirety of the free cash flow. Another thing to take a look at here, adjusted book value attributable to common shareholders, 11.1 billion in the most recent quarter. Again, when we stack that up versus our $5 billion market cap, that means that we are less than half of book value. That's very, very cheap. Why is it so cheap? I'm going to skip over these parts here for a second, and I'm going to talk about this. So, like I said previously, the company is engaged in the business of providing a financial product. Okay, annuities. If you're not familiar, you take a lump sum, like a fixed annuity. Simplified, the company takes a lump sum of your money up front and then pays it back to you over time, over a certain time period, or until your death. So it's kind of like insurance, but slightly different. So that must mean that they have a huge investment portfolio, right? Yes, and that is what it means. And it also must mean that they have a large fixed income investment portfolio, because again, insurers are going to primarily invest in fixed income. That allows them to match as well they can their liabilities to their maturities of the assets, and there's less volatility typically with fixed income. So on a GAAP basis, this is their investment portfolio, $44 billion. Okay. We see here 59% of that invested in corporate bonds, 7% in treasuries, 2% in other sovereign bonds. Here we have roughly 4% in mortgage-backed securities, of which the majority are commercial mortgage-backed. We have 15% direct mortgage loans. Of course, those are going to be commercial mortgage loans. And then we have 6% other ABS or asset-backed securities, less than 1% equities. Okay. 4% limited partnerships, which is, private equity, and less than 1% derivatives, 2% policy loans, and finally, less than 1% other invested assets. Now, a couple things to highlight here. Market to book is 0.93. In other words, the value of the fixed maturity portfolio, is 93% of cost, is my interpretation of that, which makes sense because conceivably the majority or a lot of these securities were purchased before rates went up. So that's actually not too bad. But again, bonds, if you hold till maturity and your counterparty is not bankrupt, you will get your money back. Exposure to below investment grade is 6%, which is almost entirely corporate bonds and loans. And 100% of securitized assets are investment grade. Securitized assets means asset-backed securities. Okay, so roughly this 10% here. 99% of commercial mortgage loans are first mortgage. And then this is just the statutory classification here, which is roughly, that's just a different regulatory framework, I believe. Here is the fixed maturity rating distribution, of which 98% is investment grade, meaning this. So 12% of treasuries is, very, very good credit. Then the next tier down, the next tier down, the next tier down. 37% being triple B means that they're not necessarily junk bonds, but they're higher yielding corporate bonds, of which 50% is triple Bs, representing 29% of the total investment portfolio. Of those triple Bs, there's 515 counterparties with an average position size of 24 million. So very diversified. One thing that they don't specify here are the sectors that are backing these corporate bonds. They do, however, provide that here in the asset-backed security portfolio. So we see 45% are collateralized loan obligations, but I believe that consumer loans, so phones and maybe cars, stuff like that. Timeshares, 5%. That's interesting. Music royalties, 5%. PDP wells, 4%. Data centers, aircraft, fiber, business securitizations, and small business loans, and then other. However, the creditworthiness of this portfolio is better than the corporate bond portfolio. So interesting level of ABS. And if you're familiar with ABS, within a particular CLO, there might be hundreds or thousands of loans backing the multiple tranches of that CLO. So they don't give that level of granularity, but interesting, right? Here's the granular detail on CLOs. Virtually all rated single A or above. Now, of course, if you've watched The Big Short recently, you know that a CLO is a mortgage-backed security is effectively a CLO, but in the usage of it here, they're saying a CLO in return in regards to a different type of loan than a mortgage. But you know that CLOs, CMOs were a huge driver of the Great Recession and the ensuing the financial crisis that was a cause of that. So I could see why that might spook some folks listening to this video here. However, for all intents and purposes, the CLO markets have evolved considerably over the last 20 years out of the ashes of the disaster that they created. So we know here that these are very good credit ratings. Of course, there were good credit ratings in the Great Financial Crisis that turned out to not be the case. However, standards are much better these days. But we should be aware that having really good credit ratings in the past has not necessarily been a good measure of risk. So I'm not saying that to be alarmist or not even contrarian against what they're saying here, just speaking off the top of my head. So now let's talk about the CMBS, or commercial mortgage-backed securities. 1.4 billion, of which 43% are single asset, like a single building or a single borrower, a single counterparty with maybe multiple buildings, or a conduit, just meaning that's basically like a CLO with several loans in it, right? Of the 43%, we have our breakdown here. The highest sector being office. Now, of course, I think it goes without saying that office buildings are the most beaten down sector of commercial real estate. The majority of the pain in commercial real estate is in the office market, where the other sectors have been much more insulated from the dynamics of the last couple years. Agency just means like a federal type loan there. So then commercial mortgage loans are different than mortgage-backed securities. Commercial mortgage loans are direct loans, in which case Jackson is the lender, whereas in this case, the mortgage-backed security entity is the lender, and liquidity is provided by the bondholders. So commercial mortgage loans are a much bigger portfolio, and we saw that up here, where it's 15%, 16% on a statutory basis of the portfolio's commercial mortgage loans. The NICE codes distribution here, we see 28% of those is industrial, which has been one of the better performing sectors of commercial real estate. Retail has performed surprisingly well. Multifamily, slow and steady in multifamily. Office, of course, again, representing a pretty significant chunk, 600 something million. What we need to focus on when it comes to this table even, is the bottom right hand of this table to really assess the quality of and performance of the loans. We see here, in terms of the debt service coverage ratio and the loan to value, the further along we get to the right and the further down we get, the worse it is. So when your debt service coverage ratio is below 1, it means that the property is not generating enough net operating income to service the debt. And we see here that 2.2% of all the loans fall into that bucket. And of that, 0.5% are greater than 80% loan to value. So these loans are, they may not technically be considered non-performing, or maybe they are. I'm not a mortgage lender, but that is our kind of danger zone there. But 2.2% is low. And then we see here no delinquencies and no foreclosed or real estate owned. But what that does mean, if because they are the first lien, 99% are first lien, what that means is that if the borrower defaults on the debt, that Jackson will take possession of the building, right? Because they are the first lien holder. And then we see here, they actually intelligently break down the office exposure of the commercial mortgage loans, because of course we want to know that. And we see here that the office loans are actually slightly better than the average of all the loans. We see here again in our kind of zone of doom here, 1.5% of the loans are greater than 80% LTV and less than 1% debt service coverage, or 1.8% total, less than 1%, or 1 times debt service coverage ratio. So again, those are low numbers. These look to be fairly well performing loans. One thing I want to highlight, I'm getting very granular here. I've already been talking for 30 minutes. Suburban office is superior to urban office. And the reason for that is that you have companies that are downsizing their large Class A Core Plus midtown, downtown office building and moving closer to where the workers are in the suburbs. So I'm encouraged by this pie chart here showing that 3/4 of the loans in office happen to be suburban office. One thing that I don't love is the fact that the largest exposure is in the DC area at 128 million. Of course, we know that DC has potential to be one of the worst affected markets due to government downsizing. And then we have San Jose, San Francisco, Oakland. That's where I originate, or where I'm located. That also, I would say, is probably a pretty poor office market, just because it's probably the epicenter of the work from home epidemic. So anyways, they know what they're doing. They know that you as the investor are probably concerned about the office exposure, and they've detailed that out. There's a few things to monitor here, but if all of these loans defaulted, okay, it wouldn't be that catastrophic versus a $44 billion portfolio. That would represent roughly 1%, right? A little bit like 1.5%, close to 2%. So very, very interesting. Now, one thing I do want to discuss is a big thing that's happened with the current volatility that we've seen from the tariff disruption of the last week is that interest rates on United States Treasury debt have increased. And really, interest rates on corporates have increased too. And spreads have been showing some concerning data. So there's been a lot of very concerning disruption in the fixed income market. And we know that this company has over 99% of their assets under management in fixed income. Conceivably, if we go to here, where is it? If we go to here, it's conceivable to think that this ratio is slightly lower today than it might have been at the time of this graph. It's impossible to know for certainty, but we will certainly find out in the upcoming, or hopefully we'll find out in the upcoming earnings report. However, again, as long as counterparty risk is low, that isn't necessarily problematic because again, with bonds, you get your money back if you hold till maturity, and this institutional investor is holding till maturity in an overwhelming amount of cases, especially because of the strong liquidity position. A couple of things I want to highlight here before we take a look at the financial supplement that they provide, which gives us a lot more granular detail, is as I've done a few times on the channel, I have leaned on deep research to answer some of my questions that I have about the company. The first really being like, break it down in layman's terms to me, how they make money. And I'm just going to read that for you here. So Jackson generates revenue primarily through fee income on variable annuities and related accounts, and through investment spread income on its general account assets. In variable annuities, customers invest in separate accounts, in separate account funds, similar to mutual funds. And so like mutual funds that Jackson provides, and Jackson earns fees to manage those funds, right? On those balances. So in 2024, the fee income, and we'll verify if this is correct here in a moment, and we'll try our best. They say here that it's 8.1 billion, comprising the majority of the revenue. Meanwhile, the net investment income from its general account, which is interest and dividends, but overwhelmingly interest because bonds, was about 2.86 billion in 2024. Company's filings emphasize that it earns revenues predominantly from fee income and spread income. We take money in, we invest it, and then we collect fees to manage that, and we collect a spread on those investments. Phenomenally lucrative business model. It helped explain about how to analyze the financials. As you'll see here in a moment, when we take a look at the financials, they are fairly complex. And I'm really going to try my best to work through it with the help of this. So net investment income, of course, we just referred to that. The interest dividend revenue based on the portfolio. To assess profitability, one must consider investment spread. Jackson spread income appears in its segment results, which we'll take a look at. When interest rates fall, investment yields can shrink on newly outlaid capital, not on what we're holding, while minimum guaranteed rates on policies stay in effect, compressing the spread. While rising interest rates actually, they do impact the net asset value of the investment portfolio. They actually do two things. They create more demand for annuities because annuities have higher interest rates, and they allow Jackson to invest money at higher spreads potentially. So again, spread compression is kind of a nebulous concept that's not so black and white. But one of the reasons that I first got interested in this company back in 2022 was that I just thought, okay, if interest rates go up, I'm trying to think, how can I invest money to benefit from higher interest rates that isn't just spam buying bonds? And I thought, well, annuities, right? And that's what led me to this company. Then we have the fee income. Fee income is the other major component of Jackson's revenue. It consists of fees charged on separate account assets. Jackson's fee income tends to move with the size of account values, right? Because it's like an expense ratio on a mutual fund, right? As markets rise or new deposits come in, account balances increase and fees rise. If markets fall or there are net outflows, fee revenue can decline. For example, in 2023, Jackson's fee income dropped slightly to 7.68 billion from 7.72 billion due to lower average VA account values amid a weaker market. Analysis tip: look at separate account assets on the balance sheet, which were, drumroll, 221 billion, $250 billion almost, at the end of 2024 for the separate accounts, equal to the liabilities owed to the policyholders, right? The average asset balances drives fee revenues. Also, watch Jackson's net flow of funds as an indicator of future fee-based growth or erosion. High fee income relative to total revenue indicates Jackson's earnings are heavily equity market linked, which can be lucrative in good markets. So what does that tell us? Assuming that that's correct, we see here 221 billion. That is a different portfolio than this portfolio, right? And it implies, and really specifically says, that there's more equity exposure in that separate portfolio. So let's see if we can find information about that. Here is the balance sheet, the consolidated balance sheet. Here we see total assets here, and sure enough, we see that total assets are 338 billion, $5 billion market cap. There are $338 billion that they are managing. It gives you an idea. If stocks and bonds decrease by 10%, which is what happened in 2022 and kind of what happened the last week, stocks and bonds fell at the same time, you get an idea. There's a significant amount of, like, I hate to use the word leverage, but there's a significant delta in these assets here versus the market cap. Okay, so that gives you an idea of what we're dealing with, and that also might give you an idea as to why it's trading at 3-something times earnings. So here we see total investments. They say 61 billion. I got to be honest with you, I'm a little confused why this says 61 billion. Again, this is for the time period ending December 31st, 2024, whereas this says 44 billion. I'm a little confused. Oh, okay, we see here excludes funds withheld. No, there isn't a line item for that here. Sure enough, the separate account assets are close to $250 billion, and then we see the difference between assets and liabilities is roughly $10 billion of equity. Super interesting what we're looking at here. The accountants at this company are busy. Okay, let's take a look at this. Pre-tax adjusted operating earnings. Okay, adjusted operating earnings is in relation to non-GAAP, I believe. So when we're talking about adjusted, what we're talking about are these numbers here, not the GAAP. So we see here's our fee income. Each quarter, it's been about 1.2 billion. Premiums is our life insurance. So that gives you an idea of the relative size of life insurance, uh, the life insurance business versus the separately managed accounts business. The net investment income, meaning that's our spread, right? That shows a big trajectory, and then we've got other income. So, what's our expenses? We have death, so the discharge of assets upon death. Certain annuities don't pay out at death, certain annuities do, and of course, life insurance they do. So that's somewhat consolidated there, or maybe it's exclusive to life insurance. I'm not sure. Um, then we have here. This gives you an idea of how they're selling, right? Asset-based commissions, other commissions. So in this quarter right here, you see we had like 520 million of commissions paid out. Like the life insurance is typical for agents to get a residual income commission off that, makes it very lucrative for the agents. And there's upfront commissions when they sell too. And then we have kind of our G&A expenses there. So what did that translate in? Adjusted operating earnings of 400 million, and you see how it's basically pretty flat. It's not like incredibly volatile. One thing we are seeing here is that revenue is going up. Revenue's going up over the course of the year, and has gone up by about 10% from 2023 to 2024. Okay. And then we have pre-tax adjusted operating earnings by segment. We have retail annuities are driving the profits, and then we see here that our institutional products to a much lesser extent, and then closed life and annuity blocks very volatile from period to period. Corporate and other, not sure what's going on there, but you do see that retail annuities that's what we're doing here. While we do have a life insurance segment, our retail annuities business is what we're doing here. It's what we're driving. In fact, they break it down, retail annuities exclusively. They actually say here, what's interesting, the total sales by channel. So I'm going to really try to focus on what I deem to be important. I may miss certain things, but really going to try to make sure that I, get this right. Notice how some of these segments, pretty much all of these segments actually, grew significantly, both from the beginning of the year to the end and year over year. So we went between 3.5 and 5 something billion a quarter in sales, and that went again just in annuities alone, almost 18 billion in sales, again, versus our 5 billion market cap. Okay. So here is what we were discussing, and this is where I'm going to need to lean. Net flows measure the net deposits, essentially new premiums and deposits minus withdrawals, surrenders, and benefits. This is a key operating metric for annuity companies because it indicates whether the business is growing its asset base or experiencing runoffs. They have to keep selling annuities. Obviously, if they do super well in the markets, they can continue to grow their spread income, but the sales of annuities is the primary generator of profits. We see here that we actually had net flows coming out, balance as of beginning of periods, net of reinsurance. All of these numbers were down, but then you have these numbers here. So again, net flows negative again. This right here is the differentiator. So although again for the year we had 17 billion of net flows out, we had 29 billion of positive investment performance. So yeah, well, based on what an analyst is telling us, that doesn't look great. One thing to keep in note, and this is the kicker here, we see that the variable annuity, clearly the variable annuity is a much different type of, a very different type of product versus the fixed or the general account annuity, because the variable annuity asset allocation is majority in equities. Therefore, there's much more upside. And then you see there's bond only, balanced, and money market. So there's actually quite a bit of equity exposure in these separate accounts. So what should be increasingly clear to my viewers is that this company, like when you're assembling your investment portfolio, right? You're picking different assets, assembling them together to create your investment portfolio. And this company might be of interest to you. You might feel, compelled to invest in it. I certainly have felt compelled to invest in it in the past, made a little bit of money on the trade. I've recently looked to re-enter the trade because I feel like it's come back down to a much more sensible price. But what we have to understand about the company is that it's kind of like it's highly levered, not in terms of like they borrowed a bunch of money and invested it at a spread, but they kind of did, right? It's a levered play on the markets. So therefore, it is only reasonable to see why it is much more volatile than the benchmark, because these are mutual funds in some sort of account. These policyholders have invested in this asset. And it's like your 401k or whatever. You go in, you have a menu of funds that you can buy from that are Jackson funds. They have the equity fund, the bond, the balanced, and the money market. And they're making, fees on that AUM. So therefore, when markets go up, they make more fees. When markets go down, they compress on the spread. So this company is highly leveraged, a highly levered bet on market movements. Okay. So that what that should tell us is that in terms of the price that the company goes up and down at, the valuation, all that, that there's a high degree of risk. There's a high degree of risk with this company, right? That's why it's so cheap. But the volatility of the asset also might be an opportunity and be what you're looking for if you're looking to take on a bunch of high beta, but also have like a strong income stock. So here they actually break down even more granularly what the net flows are. Fixed and fixed index, RILA, you see very strong net flows here. This is very small payout. Total retail annuity is down. Okay, so I'm about to get, I've been recording for almost an hour, which means that my screen capture is going to cut me off here in a few minutes. So what I'm going to do is I'm just going to stop it now and then I'm going to re-up. So I will be back to you momentarily. And while I was away, I actually thought that it might be helpful if I went one step further and I uploaded this report into my analyst and asked it specifically to critically analyze the net flows, given that the net flows were a pretty important analysis piece here in digesting the performance of the company. So I asked it to very critically and without bias give an idea of what that means. I didn't even mention that the flows were moving one way or another. I just said, analyze it and tell me what you think. So again, to summarize what we just looked at here, we see that on the balance of premiums and deposits versus surrenders and withdrawals, the net flows, again, look at these large amounts relative to our market cap. If you didn't know better, you'd be like, whoa, that's a lot. Are these numbers even real? So I'm just going to really try not to just read this word for word, but kind of breeze through it. So again, you see some categories up, some categories down, but on the balance, we had more net flows out than net flows in. Here you see that RILA, registered index linked net flows were very positive. But anyways, Significant outflows in traditional VA, almost $19 billion, accelerated, almost doubled from 2023, reflecting an industry-wide challenge. Legacy variable annuity contracts are maturing beyond surrender periods, and rising interest rates have made fixed products more attractive. Okay. Fixed and fixed index we see here in net flow. So that gives my initial monkey brain simplified, interest rates go up, more demand. What that actually means is interest rates or demand goes up for a particular type of annuity, leading to a pickup in lapses and withdrawals with legacy variable annuities. Despite strong sales, withdrawals were almost 3 times as much, suggesting that the in-force block is aging and redemptions are outweighing inflows. So this trend doesn't necessarily signal distress. The older block is running off as expected. What matters more is whether the newer business is growing fast enough to offset that runoff over time. And in fact, I think elsewhere in our report, we actually have a anecdote about the runoff, but we'll come back to that in a moment. Explosive growth in RILA products. RILAs saw $5.7 billion in deposits, leading to a large net inflow, basically doubling balances. This is evidence of successful product diversification and growing consumer preference for downside protection with equity-linked upside, a niche that RILAs serve well. Positive signal, the rapid growth here confirms that Jackson is executing its pivot away from traditional VAs toward modern, less capital-intensive alternatives with appeal in rising rate environments. Appeal in rising rate environments, that's important. Does that match what we see here? Yes, in fact, we do see here that sales are roughly the same. However, where only half are variable annuity sales now, whereas RILA is growing quickly. That tracks pretty well. Turnaround in fixed and fixed index annuities. Fixed annuities and FIAs saw $1.6 billion in net inflows, up from just $403 million in sales and flat net flows in 2023. The surge came primarily in Q3 and Q4 2024, suggesting Jackson responded opportunistically to rising interest rates and client demand for principal protection. This demonstrates Jackson's flexibility and shows that although they ceded much of the fixed annuity block to Athene previously, they can still compete in the space when market dynamics justify it. And then modest drag from payout annuities, negative $55 million. That's not material. I think we see how small that is in the scheme of things. So what it says, while Jackson experienced $11.7 billion in total net outflows, the net positive flows in RILA offset some of the drag. Variable annuity balances only declined slightly despite outflows thanks to strong investment performance. So that's kind of what we visually saw. And what we didn't catch is what this is kind of tuning us on to. The average retail annuity account value increased 11.6 year over year, showing that market appreciation more than offset negative net flows. So again, what we're looking at now is much more volatile markets. Okay, so that gives you an idea of why a company like this is probably going to sell off much more severely than the broader market when it does. I think if we're considering an investment in this company, we have to be ready to tolerate much higher risk than investing in the S&P 500, but for potentially much greater reward. Net outflows in VAs are expected for a mature block. Focus instead on the sales momentum and net flows and growth products. These are our growth products. Net flow drag is manageable as long as Jackson continues to grow new business and account balances remain stable or increase due to market performance. If the IRA momentum continues, Jackson could fully offset the net VA runoff by 2025, 2026, and fee income is supported by total asset values. So even with the net outflows in one segment, total account values rose, preserving and growing the fee base. So the final thought of our analyst here, Jackson's net flows in 2024 paint the picture of a business navigating a managed transition from legacy runoff to modern growth. They echo that sentiment in their presentation. While headline net outflows look large, they reflect a deliberate runoff of older, less profitable VA policies. The rapid scaling of RILAs and renewed participation in fixed products are offsetting, and when paired with market-driven growth in AUM, suggests the business is growing economically, even as some flows appear negative. This net flow profile should be seen as transitional rather than deteriorating, and a key area for monitoring in 2025 will be whether IRLA inflows continue at this pace and if VA outflows stabilize. So there you have it. There's our bogey to analyze in the upcoming earnings report set to happen roughly a month from now. One thing I want to follow up on that I mentioned earlier was, although they ceded the fixed annuity book to Athene. So here, right here. Jackson was spun off. We discussed that. It executed a major reinsurance transaction with Athene right around that time, ceding substantially all of its in-force fixed and fixed index annuity block for $25 billion in liabilities in exchange for a $1.2 billion ceding commission. This move transferred a large portion of interest rate sensitive liabilities to Athene. Wow, what timing! Improving Jackson's capital position, allowing management to focus on growth in its core VA and RILA businesses. And it talks about growing RILA sales. What about variable annuities? Okay, so what they offloaded was a big block of these. While they're still making sales, they offloaded kind of a legacy liability to another insurer, right, in exchange for $1.2 billion in payments. Whereas they're still selling that product, but they reduced their exposure. Sounds like it was a good time to do so because they're more interest rate sensitive. So I think the last thing I want to cover, and I'm going to do a really probably poor job of speaking to this well, is hedging. When you have such a large investment portfolio and it's your business of managing it, it's probably sensible to hedge. Here, they actually here guaranteed benefits and hedging results. And I would urge my viewers to maybe explore this further. But what I'm really trying to communicate here ultimately is that there's significant hedging going on. And in a market scenario where we're seeing immense downward pressure on asset prices, hedging is going to be a tailwind to the company, potentially slightly in those hedging results. And then, of course, we're seeing here net gains, losses on hedging instruments. The majority of the time, it's a cost. But sometimes they, are way up because of that. Again, gains are in parentheses there. Does appear fairly non-material on that line item there. Okay, I think that's probably enough in terms of taking a look at the financials. There's a high degree of market risk with the company, and that's really your main risk. Your main risk is that you're making money when you sell the annuities up front. You're making money along the way in the separately managed accounts, and then you're making a spread on the investment income. A lot of the internal account it's almost exclusively fixed income, and then you're selling these more equity based or equity linked products. That's kind of the growth driver right now. So there's a little bit more, I guess, equity risk in those fees. But you do see that it's, again, can't reiterate this enough, it's a levered play on the market returns. So I think it's probably safe to assume that on a given day, this stock is going to be fairly well correlated with the benchmark and interest rates, and is probably going to move significantly more than the market does on that particular day. So do with that information what you will. Let's discuss the valuation. I don't think we really need to take a look at too many things here to know that our valuation is incredibly low. We're at like a 0.5 price book. We're at less than 1 price sales. Our enterprise value sales extremely low. Price earnings growth in the trailing 12 was less than 1. That's incredibly good. On a GAAP basis, we're less than 10 times earnings. On a non-GAAP basis, we're less than 4 times earnings. Okay, so all of those metrics are lower than the sector. Almost every single metric is lower than the sector. Even the dividend yield is higher than the sector. Something I want to highlight here. Just some of these numbers, again, we did highlight how free cash flow is in the 15-ish%. I mean, just look at some of these yields, just insanely high yields, much higher than sector medians, and frankly, lower than it has been because, again, the price has appreciated quite a bit. You could have purchased this stock at an 8% dividend yield in 2023, and it appreciated so much, but it has recently come up to 4%. So while on a yield basis, again, if you would have held shares from the spinoff from Prudential, your yield on cost would be double digits. That's pretty darn good. So the valuation gets a very strong grade. But I think we need to. It gets a strong grade relative to a lot of your options out there. But again, I think we need to be cautious to the fact that it's probably not as cheap as it looks if you didn't know anything about the industry or the business. Last but not least, let's take a look at the chart. And what we're going to do here, normally I would use TradingView to do this, but I'm actually going to use the new technical analysis feature in Seeking Alpha. This just dropped today, so I'm being a good boy and I'm going to use it. Let's see if we can draw charts. How do we do this? That's interesting. Can we make it bigger? Maybe let's zoom in a little bit. Okay, that's a little bit better. So what initially happened here was the stock started trading, and it was kind of a pariah in the stock world because nobody really knew what to do with it when it IPO'd or spun out initially. So it kind of traded up and down, super volatile. I remember I first bought some shares of it. I put a huge amount of my portfolio in it, thinking that it was just this phenomenal investment. And it was very early on, right around here. I remember it going up a lot and then going down a lot. And I was kind of weird. I was like, oh man, this volatility, I'm not cut out for this, right? But you see here, it was trading down here. This is like $25 all the way up to 50. So it doubled all the way back down. But then it kind of found some momentum here because Wall Street kind of caught on to the fact that they're buying so much shares. They had raised the dividend here again. The company had first gotten rolling. They paid their first 4 dividend. They increased the dividend. It's obviously phenomenally volatile. This is a bear market in the S&P here. And then it kind of started to find legs because stocks started to go up again. And then, again, just phenomenal run. It went from 30 to over 110. So almost a 4x, 3 an X in like a year time frame, just destroyed the market, right? Well, it's been in a downtrend. Still getting used to this. It's been in a downtrend here since it peaked. Been in a very, very sharp correction here. It sharply rallied, as all stocks did, from about where it is now, almost exactly where it is now, roughly around where the election was, and it rallied all the way up. And then before the start of the new year, started to dive a little bit, and we see some pretty extreme volatility. Above 110 a share all the way to 100, more than a 10% drawdown. And then from 100 all the way to 85, 15%, right? Back up to 100. And then again, hit a new local low of 67 here. So what are we looking at here, folks? We're looking at a pretty sharp drawdown here and just neatly within this channel, right? Neatly within this channel, it's drawing down. And again, what did I say earlier about market beta? It's moving in lockstep. The fact that bonds are selling off somewhat and equities are selling off quite a bit and have sold off again quite a bit is giving you the information you need to interpret this. It hasn't broken out. And I really don't know what markets are going to do. I purely want to pick up assets at good prices and continue to do so. The fact that this has a very strong yield makes it very attractive. Again, we're looking at 4%, greater than 4% dividend yield, potentially growing in the mid-teens per year, at least for the next couple years. that's a very, very, very strong income return. So I think there's lots of risk. There's lots of downside risk with this stock right now. It's definitely not defensive. It's the opposite of that. It's kind of like levered beta almost with this name. However, if you have a really long time horizon and you're comfortable with accumulating shares all the way down until it finds a base because you're comfortable with that income, maybe you expect that the market continues to go up, I would continue to watch this. I really hesitate to say that it's a buy here, just because it's, again, there's tons of risk in the markets, but I'm certainly comfortable buying it here. However, as none of my videos are a recommendation to do so, and there's some of the calls that I've made in terms of buys, I've really wanted to kind of reframe what that actually means. I'm looking at a company that I really like that is acting in a shareholder friendly way, and I think that that's a good investment on a yield basis. I believe that this falls into that camp. However, I would not expect this asset to outperform the market in either direction, not outperform the market in general. So when it's going down, it's probably going to go down sharper. When it's going up, it's going to go up sharper. That would be my expectation. So I think it's compelling where it is here. There's a lot to like about it. I think that it's for a certain type of investor, somebody with a long time horizon that's looking to rapidly grow income. It's a really, really interesting stock. But for, retirees, people looking to shield themselves from the volatility, this is not a defensive stock. It's not a good buy for that type of investor. But I think for a growth oriented investor, particularly a income growth oriented investor, it certainly looks attractive at the current price. But the chart does not look good, folks. The chart technical analysis does not look good. It's broken out of the uptrend and is just now in this sharp downtrend. Doesn't mean it can't outperform from here, but this chart ain't looking good, folks. So my grade is, for me, it's a buy, although I don't know if I'm willing to stamp it with that for all investors. I think it's a buy for a long time horizon, and folks that are really willing to stomach the volatility and also want to make sure that their portfolio has beta in it, like mine. Today, when we rebounded by 8, 9, 10%, my portfolio was up 5%. I'm outperforming the market year to date, but underperformed a benchmark by 500 basis points because I'm very defensively allocated. So that gives you an idea. So that's going to be it for the video. Again, very, very interesting company. Lots of risks that I'm willing to tolerate. But if we continue to tumble down, it's just going to look better and better. And I think the main thing there to pay attention to is the net flow profile, particularly the net flow profile in RILAs, because that's our growth driver. I think that's clearly borne out in the financials, and the numbers look good. They're hard to interpret. So anyways, that's going to be our video today. Hopefully you found this interesting and useful. I've certainly had a good time. We've talked for almost 90 minutes here. So let me know what you think. Certainly interested to hear your thoughts. And in the meantime, I'm going to continue on to the next video. Anyways, it's been fun, and I look forward to doing it again soon. All right. Have a good day. See ya.